I am joined by Victoria Greene, Chief Investment Officer at G Squared Private Wealth. Victoria, welcome to Forward Guidance.
Hey, thanks for having me.
Great to have you. I want to talk shop, as you say, talk markets. I love talking markets. Can you just tell our audience a little bit about what you do, your company, and sort of what you invest in?
Sure. So we're a ultra high net worth private wealth boutique firm. We work with individuals typically with 10 million plus. We do portfolio management, some family office services, and making sure that their lives are just a little bit easier. So a lot of times we're not a hedge fund. We're trying to sustain wealth, build wealth, generational wealth, and then generally make sure that they can meet their goals and objectives. So if they have $25 million, that means you can't necessarily spend $3 million a year, which sometimes is not a fun conversation to have with people. You know, it's amazing that people can have the burn rate, but and then really we focus on good, smart portfolio management. So how do we make you money in the long term? How do we avoid bad decisions? How are we tax efficient? You know, and really our goal is to maximize as much as possible the net after tax return to the client. So that means if I'm turning and burning and realizing a bunch of short-term capital gains for you, that may not be in your best interest.
Yes. So people trust their savings with you, and you really have to make sure that they make good decisions. So you're not just sort of expressing a macro view. It's not just, oh my God, I love Apple and I don't like Amazon, or I think the Fed is going to hike and we're going to get into that, or I think the price of oil is going to go to 300 or negative. It's actually you're managing people's wealth over time. Can you talk a little bit about what it's like if you have a macro view, or if you want to get a little bit more aggressive into stocks or a little bit less aggressive out of stocks? How do you don't just make a pivot? Perhaps a retail investor, they can go 100% S&P 500 to negative 100 S&P 500 in a day, but you can't just do that, right? You got to be responsible.
No, and I would argue the investor that does that usually is doing it poorly. So no, we typically are moving gradually or in shifts. So we'll have different kind of a waterfall or a layer cake necessarily. We have to have some liquidity, and maybe we'll have some T-bills and then some munis and then our large cap growth or value. And then there's things like we started shifting out of large growth in 21. So we were more in value. And if there's something material that happens, sure, I can take your whole value allocation and move it over just like that. That's not a problem. But we also have to be kind of cognizant of what the effect is. If it's a short-term pullback and I'm going to cause you $1 million or $2 million in capital gains, is it really worth it? You got to really think through, okay, is this a fundamental shift, or is this just some noise and it's going to be ugly for a little bit and you're going to want to throw up every time you read your statement? But at the end of the day, you're better off just grin and bearing it, because why do I want to necessarily sell, realize a bunch of tax consequences, and then what, I'm calling you in 6 months to buy it back? Like, there's an actual true cost to a lot of investors. So I think you just have to be firm on your views. You have to have conviction. And I always say there's such a fine line between conviction and stupidity, and you got to make sure you walk it, right? Because conviction in a trade means, hey, maybe it's not going well yet, or maybe I'm wrong short term, or, there's a lot of pressure, but I still think this is going to work. And you have to be very certain that you're not falling into biases, right? That you're looking for confirmation of information, that just, you're looking at everything deeply, you're stress testing it, you're looking at different sources, you're asking yourself, am I right? And if you have conviction, often it's best just to grin and bear it, because if it's short term and we're in a taxable account, then I don't really think it does you anything to liquidate. That doesn't mean we're not active. We've been harvesting losses everywhere this year. Absolutely. You have a long-term loss, I want to book it because I can carry those forward. And so you have to be active and you have to be prudent, but you really need to be focused on, do I think the market's going to be higher a year from now? Yes, I do actually. In a year, I think it'll be higher. In 5 years, yes. Then some of these shifts, it's more, okay, what parts of the markets do I want to own? And then how do I benefit you, the client? Can I do all of this tax loss selling? Can I put you in some proxies? Can I, shorten up and look at how much we're getting paid on the front end right now and make you more income than you used to be making on bonds, and make sure we're minimizing cash drag? All those things that maybe they add a 0.5 percentage point, but I heard it explained once, it's like swimming laps in a pool. If you're swimming 500 meters and you want to take a minute off, you don't just swim one lap a minute faster. You're trying to take 10 seconds off every lap. So if I can continue to make good decisions for you, help you avoid bad decisions, then we're picking up all of those basis points, and it really adds up by the end of the year. And so we really focus on efficiency. And then you have to fight your personal biases. And a lot of times we're talking clients through very difficult periods. So, right now there's a lot of stress in the market, and, the fundamental buy low and sell high, we override that, right? We're creatures of fight or flight, and the desire to flight right now is extremely high. And so a lot of times we just want to give you good data points. Okay, so let's talk through the pros and cons. Let's talk through what can happen. At the end of the day, it's truly your money. So if you tell me to sell, we'll absolutely sell and sit you on the sidelines. I don't care. I get paid either way. I'm fee-based. But we want to tell you, the pros and cons. What are the risks? What are the opportunity costs? What are the true costs, about taxes? And really, what are you trying to solve? So if you're just saying, I'm worried it's going to go down another 10%, I would argue a lot of investors are better off just holding that 10% and grin and bearing it than trying to time it. Because when that market turns, I'm going to call you and say, hey, maybe we should buy this. And you're going to think I'm insane because you already think the world is terrible right now. Just wait till the market goes down further. It's going to feel like a complete dumpster fire. And so it's very hard for investors actually to get back in. We talk ourselves into it. Well, we know the market's going to go. We know the market's going to go down. So great, let's sell and sit on the sidelines. But one, do we really know? Like the Fed could change its mind. We could have new data come out. Like things happen all the time. If the market followed a very known path, there wouldn't be a market. We'd all know. And then two is it's very hard to actually pull the trigger at a bottom because it's going to feel worse. Like when the market bottomed in 2020, it was March and everything was terrible, right? So yeah, it was going down 10%, but at that point, more people were thinking, well, this is like the end of the stock market. We're going to go to zero than people were thinking to buy it. And then even look at 2008, when we bottomed in March of 2009, unemployment was still rising. Things were terrible. We generally thought this was going to be a Great Depression. And so we talk about, I'll just know when to get back in. But I'm like, really? Really? You're going to tell me you're scared now and you're going to pull the trigger when things are worse? And it's very hard to do.
And you did, though. You did you did have a cautious view on the market. You've been positioning your clients away from sort of the high beta risk assets into sort of safe stuff. Tell us why you did that, and also you said you rotated out of large cap growth last year. Why did you do that?
Yeah. So there's nothing wrong with them. I'll say this. I'm not a tech hater. First off, I own like 7 Apple products. So obviously I like solely support Apple stock price with just the things I buy. But we got worried, right? So one, the growth versus value is that had gotten so wide and dispersed, and everything is mean reverting. Like I think the 4 most dangerous words to an investor is this time it's different. It's never different. It might be a slightly different pattern or a different speed, but anytime you get to that point that they got on valuations and that massive outperformance of growth versus value, you should be getting cautious because everything does kind of revert to historical means. A great example is like the ARK funds. People started piling into them right around the time they started rolling over, because then at that point it was they can do no wrong. The entire world's going to run on Zoom video and Teladoc and Teslas, and then suddenly that view shifted really fast. So not necessarily, it was a little contrarian, definitely, but we want to be sellers. And again, it's often a fight. We want to sell after 2, 30, 40% up years. Why wouldn't you want to sell some? At least trim off your gains. I'm not saying you have to abandon your position entirely, but if you've made that much money, why wouldn't you want to trim back and actually bank some of your profit? Because it's not a profit until it's actually in your pocket, right? At that point, it's paper gains that can go away just as fast as they came. So we were looking at the trajectory of the market. We were looking at the recovery off of the 2020 bottoms. We were looking at where things were trading, and we realized we just wanted to be more defensive, and we thought we had gotten overstretched. So we started selling then. We sold some more at the beginning of this year, and value's been a really nice buffer. We've been long energy. We've been talking about energy energy ever since basically the 2020 bottom, because we thought that was a ridiculous oversell. So it's not rocket science, but it's also really hard to make some of these trades because you're going against what other people think is going to work. So I'm not saying energy, are we peak oil demand right now? Possibly. Obviously EVs are coming. If it's hydrogen, if it's battery powered, everybody's got EV fleets that are coming from GM to BMW, and so I'm not agnostic to long-term trends, but it also takes a little bit longer to adopt, right? We've got a lot of infrastructure we need to build. There's cost of buying those that are difficult. You actually have to build that many cars. And then, do you remember Obama's cash for clunkers? Mm-hmm. That was trying to get some really, really, really old trucks off the road. And they thought those things would be gone by now. And you ended up having to pay people to give up their old cars to get to emission standards. So kind of look at that and you realize adoption's a little bit slower. So I think you just have to feel comfortable. And again, buy low, sell high. When we were selling at the end of last year, tech stocks were flying extremely high. And you'd had these back-to-back years that they made so much money. And, I'm not going to say we got out of it completely. I wish I could say that. But, we certainly trimmed the position back and we've been taking all those gains back off. And that helped bunker us a little bit better and be a little bit more prepared, because I am a proponent that, history rhymes. So anytime you have these massive run-ups like we saw off the 2020 low, we're getting nervous, right? We were hitting levels that were very overvalued, and it's hard. Sometimes investors just look at the S&P 500 and I have to remind them that right now, as a cap-weighted index, it's very similar to the Russell 1000 growth or the NASDAQ. Not quite as volatile as the NASDAQ, but so tech-heavy. You start looking at the top 10 stocks and you realize, you're owning the FANG plus Tesla, basically, when you own SPY or any of the S&P 500. Nothing wrong with that, but, people think it's this big diversified index because it's got 500 stocks in it, but you kind of start to look at the weighting and you realize 10 stocks are going to dominate how that index does, and the other 490, they kind of matter, but not really.
Over the past 10 years, Victoria, I think people who bought the dips have been rewarded. If the S&P sells off 8%, you got to buy, you will be rewarded for that. But I get the sense that over this past year, as the S&P 500 went down 8%, you weren't convinced that now is the time to buy the dip. Why? Yeah, and I just want to make that clear for the audience that, you have had what is for you an unusually, a bearish bias this year. So you have been right, as well as long energy. What is that view centered around? It hasn't centered around necessarily the growth value. It's more around the Fed, around inflation. Just share us your macro thesis and why you thought, this wasn't a minor blip. This was like a serious correction could be on the horizon.
Yeah. So it was like clockwork in 21. Remember, we'd go down 10% and it was literally like it hit like 999 and it bounced and it bounced and it hit that trend line, and that uptrend support was in there and support started breaking. And then, we saw what was happening with Russia and Ukraine and the macro, and that started changing opinions. And I think that's one thing, we talked about conviction earlier. You have to be willing to change if the data changes. Like, you can't just put blinkers on and be like, no, everything's fine still. And I think investors have to be willing to take new data, not to say you knee jerk on it. Not every data point is important or market moving. But if you get new data, then you have to be willing to change what you see in the market. So yeah, we were absolutely buyers of the dips because that worked like clockwork, right? Went down 10%, you bought it. It went back up and it hit new highs. Went down 10% and you bought it. But then we started hitting lower highs, right? So instead of higher highs and pushing up, every time we were bouncing a little bit, we were hitting lower highs, which is a bad chart pattern to have. And then your macro started changing fairly quickly. And so I think you kind of start looking at those and you realize, hey, I need to be a little more cautious. And, we're looking for signals that absolutely we're be buyers of this market. I think it's still a little early. We haven't really been deploying a lot of capital to snap things up. I think it's a little early for growth since the Fed, and our view is going to continue to be hawkish. And we adhere by the prime directive, don't fight the Fed. And right now the Fed is tightening. The Fed's going to run off their balance sheet a little bit. And we always look for catalysts. So we're always thinking about what are we looking for? What's been changing? So for us, what we're really looking for right now is that if unemployment starts creeping up, which it might, you're starting to see tech companies, right? They're starting to have some layoffs in the more aggressive sectors. So right now, the Fed is laser focused, and they've said that they're fully committed on inflation, and whatever happens in the labor market, they really don't care because the labor market's so tight, it's absorbing any problems. After this labor market starts to kind of creep up a little bit and unemployment rate starts to creep up, at some point, the Fed's going to have to say, hey, we can't have this singular focus on inflation. We've got to, we got to worry about unemployment. And at that point, that's when I think they're going to switch a little bit more dovish. And at that point is definitely an area that I want to be a market buyer. But right now, I would ask, what would stop the Fed from continuing to hike? What possible reason? There's no rule saying they can't go over 3%. And, there's things we think that'll happen, but, they're going to keep going and they're going to go at a fast clip because, quite frankly, the market absorbed 75 basis points just fine in June. And I think the market is ready for 75 in July. And there's then this lovely gap in August because nobody in finance works in August. And then, we come back to work in September. And there is going to be a substantial data gap between now and September. So I'm going to say I'm a little data dependent, but I wouldn't be surprised to see 50 in September. Because if the market is still able to do it, the Fed wants to put as much distance between them and zero. So then they have tools to ease as the economy rolls over. I'm not a proponent they'll be able to do a soft landing. I think it's very difficult with the very high inflation numbers. And there's so many things they don't control. Like they can't go out and drill for more oil. They can't, get Putin to sign a peace agreement. They can't really go dock ships in the LA ports. There's a lot of things the Fed cannot do to fight inflation. So they're going to be fighting external forces that really is not something they can control. So all they control is raising rates and balance sheet. And they want price stability. And we remind our clients all the time right now, the Fed is not here if your company's losing money. So if Apple goes down, that's not the Fed's problem, right? We kind of forgot about that because they did bail us out in 2020. But just because the stock market goes down, that's not the Fed's problem. The only time it's going to be their problem is if liquidity locks up and suddenly you're having these dislocations and the market starts to not work, either bonds or stocks, but mostly typically it starts in the bond or the money market. If they lock up, then yeah, the Fed may come in and try to provide liquidity because that then, invalidates their price stability and market stability, and they need the bond and the money markets to work. So they did that in 2020. We did actually learn things from the Great Depression in 2008. And so they realized, yes, I actually think as much as there was way too much excess, there was a great deal of good things that they did in 2020, because all things considered, as much as the world shut down, you did not have that steamroll into a Great Depression. And I think that everybody, yes, there was maybe a little bit too much extra stimulus on the back end we didn't need that caused this inflation problem. But during that early part of 2020, I think there was concern we could have an 08 or a 32 type event, and you were going to see multiple people in long-term unemployment, and then you're going to see housing fall apart, and we saw how well that worked in 08 when housing falls apart. So generally speaking, they did handle that fairly well, but now we're in a different situation where they have to remove liquidity from the market. And that's not good for stocks. There's nobody there kind of providing that. They're actually actively trying to take it away from you, and that tends to be a very uphill battle.
I want to hone in on that. So you say the Fed is withdrawing liquidity, but if there is no liquidity, then the Fed will come back. In what way are you seeing the Federal Reserve's actions, both on rates as well as quantitative tightening, impact the market conditions? So, for example, if I, as a retail investor, buy Apple, I see the price is $140. Maybe it's $140 bid, a 140 and 1 penny ask. But I just do it at the market. But a lot of your clients are quite wealthy individuals. So if you're trading in size, are you noticing? Oh wow, hey, what is this? 140, 142 ask, or obviously not that big. But in sort of some of the more illiquid stocks, are you seeing just an ability to enter and exit positions? Has that ability less so now that, yeah.
That's funny you asked. There was actually an article this morning on Bloomberg I was reading about the credit markets are actually having a little bit of that problem, that some mutual funds that used to be able to unload a position in a couple days are now struggling over weeks. And a lot of banks are coming out warning that they don't want to trade that stuff. They don't want it on their balance sheets. And so you're seeing this disconnect happen a little bit, mostly in the credit markets and the high yield space. So yeah, you're seeing wider spreads there. But even like the Treasury auction this week wasn't that great. So you're seeing some of these signals that you just just have less buyers and sellers. And we're still getting pretty good bid-ask spreads. Some of it's your best execution on the platforms you're using. You just have to be knowledgeable, trade in blocks, the bigger size, because sometimes small blocks you tend to get a little bit, right? You're buying a couple shares, you tend to not always get the best price, or you get a little bit, couple pennies, but it adds up. And I think also it's where you're trading in the market. So Apple is still, like any of the large caps, they're still very, very liquid. And yeah, they're volatile, but the bid asks are still pretty tight. You go down on the small cap market, then I think, you're going to have a little bit more trouble trading stuff. Well, you can trade it. It's just whatever price you get, you're going to have to just take. And it may be a much wider spread than investors are used to. And I think investors, if you're trading anything risky, you should really be looking at your bid-ask spread and going on some sort of analytics software to see what the market's doing and what you're being offered, because typically you trade through a platform, right? And not that you have a lot of choice. You either take the price they want, or you set a limit order, or you don't buy it or sell it. A lot of investors aren't institutions or hedge funds that can pick up the phone and call 10 trading desks and ram something through. But you want to be really focusing on, you may have to unload a position slower. Maybe instead of selling 100 shares, you're selling 10 shares over 10 days so you don't move the market. And just that acknowledgement that with heightened risk, typically you see this dry up a little bit, and then you just have to be wary. And I think the biggest thing is if the market's in a lockup day, like we're down 1,000 points, that's a terrible day to sell, because that's the day you're going to get the worst price, because that's the day traders love, because they know they're going to see panicked people that are fire selling. So they will give you the worst price possible. Why not? Because you're going to take whatever price they give you if you're on a panic. So I think you definitely have to fight that desire to sell on those nasty days, because I think that's where you're most at risk, and either wait or sell little bits. And that way you can kind of control a little bit better, not getting, not having a liquid investment. So I would look at your portfolio, especially small caps or lightly traded stuff. Make sure you feel comfortable holding it. You might be holding it a little bit, or you need to be prepared of the small block allocations. And right now, I think you need to be stress testing your risk. Like, can you afford to wait a year to sell this? If you can't afford to wait a year, maybe, and you're going to need this to pay your utility bill, maybe it's not the right investment for you. I think it's a good time for investors to do a gut check. Everybody's risky and everybody loves taking risk when the markets are going up. And then suddenly we find out everybody's true risk tolerance when the markets start turning around and going down. And I'm going to tell you, being a good investor is you need to be a good investor in the up markets and the down markets. And being a bad investor during down markets tends to destroy more wealth than you'll ever build on the up market. So, but liquidity always trumps portfolio strategy, because if you got to pay a bill, I don't care how down your positions are, you're going to have to pay your bill somehow. So I do definitely tell people they need to understand their liquidity needs. You need to have a little bit of a buffer so you can withstand any downside volatility, or having some income sources in that'll support you. But, think about your Maslow's hierarchies of needs. If you don't have money to pay your bills, you probably shouldn't have all of it in risky investments. And I get sometimes it's this lure, right, that you see other people getting rich and Reddit. And I hate to tell people this, but people lie on the internet all the time. So people will go and brag about that one trade they got right, and they'll give you a screenshot of how much money, and you're going to be like, oh man, that person's so smart. And they're not telling you about like the 30 of them they got wrong and lost like 5 times as much money than the one they got right. So some of that stuff is very hard to do. And I'm very happy that platforms have engaged investors, especially young investors. I fully love that. You never get back time. There's so many things you can do in investing, but you will never get back the time you didn't invest. But you also need some boring investments that are just some steady eddies. You don't need everything to be a trading account. You need something boring that if your trading account blows up, you still are benefiting from the time that it's sitting there and working for you. So nobody likes that. It's not a popular view. It's much more fun to trade everything. But a lot of times you're better off having a boring account, and that's your steady eddy. And that's really what you plan on living and retiring on. And then I'll be super happy for you if you hit some small cap that goes up 1,000%. But I also think you're more at risk of probably losing that than you are at hitting those big jackpot winners. It's like going to Vegas. If you're trading, it's a lot more like Vegas, right?
Right.
Every now and then somebody does hit that big jackpot. People definitely can go to Vegas and win money. But if you play the probability game, the vast majority of people go to Vegas and lose money. But at least when you go to Vegas, it's fun to lose money. I mean, in the stock market, it just kind of gives you heartburn.
Yeah. And in the stock market, everyone makes and loses money all at the exact same time.
Yep, pretty much.
I remember in 2021 noticing, wow, the more junk the company is, the more it's going up. The more debt it has, the
Exactly.
more speculative the future business prospects. Victoria, you said that you were attracted to boring companies, boring investments in 2022. Why was that the case, and why do you think it is that the more exciting companies of 2020 and 2021 are the ones that have performed the worst?
It's about quality. So a boring company has good balance sheet, sustainable cash flow, lower, your debt's lower, usually pays a dividend. There's stability. They're more blue chips. And so like an IBM, I love to talk about IBM because everybody kind of forgets it exists. It still exists. It's a very profitable company. And they're kind of doing a turnaround now where they spun off Kyndryl and they're working on the hybrid cloud with the Red Hat acquisition they did a couple years ago. And it's a decent company, but it pays a 5% yield. It's trading at like a 14-time multiple in tech. And it's a very necessary service for a lot of companies. Even if you have layoffs, you still need IT. Like IT is typically like the last area they lay off because there's no way you can get without IT. You need people that understand how the servers work and how to actually get you logged back in when you forget your passwords and generally still doing cybersecurity and network and consulting. So I think that area is very resilient revenue. So when you're looking around the market, that's one of the things I think I like is right now a resilient revenue stream. So not something that if some people are paying more on food and gas that they're going to stop buying your product. It's more people have to buy your product or people are going to use you. So like a Costco or a Walmart tend to historically do very well during times of stress because they're kind of bargain shopping. And we want to look for that. We're going to want to look for things that people will still want to buy even if they're under stress. So the high flyers, and no offense, Kathy Wood I think is a brilliant person and her funds are wonderful funds. They're just difficult in this market. Innovation typically comes with cash burn. You're trying to change something, you're doing a lot of R&D, your balance sheet's usually a little terrible, and then you're burning cash because you're trying to either aggressively enter new markets or you're trying to develop new products or you're doing something different, which historically means you're not actually banking a lot of profit because you're trying to aggressively change something. That's really hard when liquidity slows down and the world slows down. Because typically those more aggressive companies have trouble finding debt at a reasonable price. So let's say you want to expand, you're trying to refinance debt and you're a more aggressive company, that tends to put a lot of pressure on you to actually do that in a time of stress. Because banks are going to want to loan to the IBMs before they loan to little old startup here that's going to possibly change the world or, maybe not. Changing the world is extremely difficult and many companies set out to do that. And let's talk about Zoom, for instance. So Zoom is a great product. There's nothing against Zoom. It was a pandemic darling. It definitely got way, way, way too expensive. But the problem with Zoom is I now have a lot of people that like Teams now, and Microsoft did a better job. You have Slack, you have other technology coming in, and their barriers to entry are not that high. So everybody basically uses Microsoft Office Suite, most everybody. And so sometimes having the Teams integration, or you've got like a Ring Central, VoIP, or however you run your company, you tend to work within your own ecosystem. So I think Zoom has a great product. I think it's going to be difficult for them to grow because a lot of people bought their product and, and they'll have subscription, but that's recurring revenue. How do you actually grow your company? And they're trying, they're coming out with new features, but I think they're a good poster child. If everybody got super excited about them, there was a time they were certainly undervalued. We all started using Zoom, and then now it is part of one Office suite. It's no longer innovative. It's no longer new. It's a tool to be used. And then you have competition.
How do you think about a floor, which is a very dangerous word to in investment world, almost as dangerous as the word ceiling? But let's take a value company like, I don't know, AT&T, or let's say Berkshire Hathaway. Berkshire Hathaway, God forbid, got cut in half. The S&P 500 would do very poorly, but there would become a certain level where you're saying, okay, they have this railroad, they have utilities, they have all these equities. Like at some point, it's trading below its book value. It's trading. You could say, I'm not putting a floor on how low it will go, but I'm putting a floor of intrinsic value within a margin of safety. Yeah. But how do you do that on something like Zoom, which has a good business model, it is profitable, or something I might say that is not a profitable company? I won't name any names, but there have been tons of companies that have come out of Silicon Valley, have never ever made a dime in profit. They probably don't know what that word means. And in the best possible world where everyone was staying at home during 2020, they were still extremely unprofitable. If let's say a stock that and again, I'll just say Zoom because you mentioned Zoom. Zoom's went from $500 to $100. Where is the intrinsic value? Where's the bottom? Where's the floor?
Yeah, so it's going to depend stock by stock, but I'm going to say just because a stock drops, 70% doesn't mean it can't continue to drop the rest of the 30. So you go from 500 to 100, that really, really hurts, but there's nothing stopping that from going from 100 to 7 or from 100 to 30 and dropping a further 70%. And eventually it'll hit zero. But as you mentioned, some of these unprofitable companies, people talk about the tech bubble. I'm like, we're already in our own bubble. You saw the ARK fund bubble type and the unprofitable companies bubble. And I think they're still going to be punished. And you need to feel comfortable that your stock's not going to go to zero. And sometimes if you have a bad stock that doesn't actually make money and has a lot of debt, you need to fully consider that it can actually go to zero. And sometimes you get, you have a sunk cost in it and then you talk yourself into keeping it. And there's sometimes a reason it went down 70%. It's not just because it fell out of favor or blame the hedge funds or all the other reasons we love to blame the head for why stocks go down. But sometimes there's a reason things trade where they are, and they're called value traps. So just because it's trading where it is doesn't make it a good stock or a good value, because if it has no profitability and it has high debt, that can definitely go to zero. And I would lovingly remind everybody of pets.com and that whole debacle back in the 2000s. Least we forget, 2000 was a great example of unprofitable companies that when the tides turned, got punished and went out of business. Now, there are phoenixes that rise from the ashes. I mean, Amazon was under a ton of pressure and they managed to make it through and they're hugely profitable. But for every Amazon, you're going to have 100 pets.com. So watch out for your unprofitability. There's 60% or something of the Russell 3000 that don't actually make money. And I think you need to be very, very careful about jumping into those right now, because I don't think we're through with the market stress. And if you don't make money, you have no profit and you have a lot of debt, first off, you're going to have trouble financing stuff because banks are going to look at you and say, yeah, no, not in this environment, not at all. And you're either going to have to pay a massive sum of interest to get money, or you're not going to get financing at all. And then you get under pressure. And a lot of companies also don't really handle pressure well. It depends on the strength of your leadership. I would argue, Bezos really pulled Amazon through. He was a realist. He reached out to people for financing. He made changes. Sometimes CEOs aren't that smart. And it's hard because if you're managing a tech startup, a lot of times you are the techie guy that started it. And maybe you're not the best manager or business strategist. Not everybody's good at everything. And so you have to look at that and say, okay, so I have a company under stress. It's not making money. Maybe it has a great product that just hasn't been developed yet. But not even just having a good product. You got to be able to sell that product. You got to market that product. You got to innovate that product. Take an Apple, for example. They started with computers, and now we know them basically for phones. And I bet you in about 15 years, all we're going to know them for is wearable tech and the chip in our head, or whenever we get to there. But the Apple has continued to evolve, and that takes some good, strong leadership. So just be careful, because sometimes there's a reason things get hit that hard. It's not just because it's unloved. That sometimes the company can struggle. And the other flip side of this is sometimes there's great acquisitions. So sometimes you'll have a crappy company with a good product that gets under pressure, and you have an Apple or an Amazon with billions and billions, or a Berkshire with so much cash that they love pullbacks. You talk to Warren Buffett. Warren Buffett loves it when the market drops, because then he can discount shop, and that's what he wants to buy. And so typically under stress, you see consolidation. You saw that when the energy market froze up, and you saw Parsley get snapped up and some of these other operators get snapped up and merged, which were good deals for the companies that got them, because they got pretty good product, just because the company got under stress and people panicked and maybe they didn't have enough liquidity. So not always a death knell, but the company may cease to exist in some form or another.
So that's the world of listed equities. What about the more opaque worlds of venture capital, private equity, as well as SPACs? Are you, do you and your clients get involved in, do you guys swim in those waters as well? Or, so what are you sort of seeing there?
So SPACs were a really great way for rich people to get richer. I'm going to say the only people that made money in SPACs were the people that were sponsoring the SPACs and the banks. And they were a really, really profitable way for those people to make money. I think SPACs made sense when it was a specific thing, like what DraftKings was, I would say, a successful SPAC. But that was a planned and, cut the IPO thing. And then you have that just explode and everybody has a SPAC and they're raising money and you're saying, oh, he's a smart guy. He's going to find something to buy. And it's a little more complicated than that. So the concept of a SPAC, I don't hate. I did hate where the market went. And I think a lot of people got taken advantage of because it's super easy to make promises because you actually have like minimal disclosures you have to make. You're saying, give me my money and I'll go buy something maybe in this industry, maybe at some point. And then that, and I feel like people formed them without actually having targets, which of course they didn't say. Of course they said they had targets, but, you saw a lot of SPACs fail. And I think the failure rate was something like 90% or the trading below the IPO price or whatever. So those, I think you can still have a good one. You just need to be aware of what you're buying. And, a wing and a prayer is not necessarily a great investment strategy. And everything's going to sound good. Like I've never met a product that has a bad back test and I've never met a SPAC that didn't have some amazing marketing materials. So everything sounds good, but if it's too good to be true, probably is. So if they're promising you these crazy returns, probably is wrong. Private equity, I think, is a good space to be in. Liquidity tends to make you more money. I think there's going to be a lot of things changing over the next decade. Anything from real estate continuing to shift and what happens to commercial real estate as work from home. Work from home is not going away. Hybrid work, I think companies definitely still want people in the offices, but I think there's going to have to be an acceptance of work from home for some departments. Like technology is a very great department that really IT does not actually need to probably go into the office because they can just remote in and there's very few problems they can't fix that way. And so there are some departments, I think, that work better as a remote department and some departments that need more collaboration or in person. But, what's that going to do as this acceptance has kind of happened? And it's almost a forced acceptance because I think a lot of employees are saying, yeah, no, I'm not going back to the office. That's really cool. Glad you're making us come back to work. Here's my 2-week notice. We're in a tight labor market. I'm going to jump to company B. That's going to let me work from home. And commuting right now also is like a massive strain on people's budgets. So people are much less willing to come in unless there's a viable reason to come in. But so that's going to continue to shift the environment. And I like private equity because, again, you have to do your due diligence. Don't just buy a PE fund because it looks nice and bright and shiny. We tend to like managers that have a track record. We tend to not do startup funds or a first vintage fund. Everybody says, oh, I used to work at Goldman or at Blackstone and, I'm really good at what I do, I promise. But sometimes it's a little bit harder than I anticipated when they're outside of the ecosystem they used to exist in. So, we look at that as a way to supplement returns. It does help kind of offset some risk. You have some smoothing there. You're buying real assets. Real assets do tend to have a very good, they tend to be a good hold. So, and they tend to be patient. And when you do private equity, you kind of take some of the emotion out of it because you don't have a choice. You're stuck unless you die. Like you're not getting back out of that unless you die or find somebody to buy it from you. And even then, sometimes transferring interest, they won't let you do it. So some of it's also taking out that bad decision from investors and saying, look, you're a real estate company or even if you're your early stage company or whatever you are, I'm going to let you handle this money. You're going to make good decisions. And it's good for investors because it's also usually capital call, right? A lot of private equity, you say, yeah, I'll put $1 million in your fund, but you don't give them $1 million up front. You typically, they typically have some investments lined up. They close, you give them 200,000. And then sometimes even it starts kicking off income or money or distributions, and you end up not even having to put in what your initial call amount was because they can distribute it back. I like private equity. I think people need to be careful. I know they're coming out with interval funds, which is basically hedge fund light. It's a hedge fund and a mutual fund wrapper where it's like redemptions are smooth and quarterly. And I tend to be very suspect of any new product on the street. Not to say it can't work, right? There's lots of things that can work. But typically, if everybody starts doing something super fast, that is not a great sign. And you also have people that are going to do it badly. So just because somebody has an interval fund doesn't mean it's a well-run interval fund. And I think you have to have a purpose. So if you're willing to give up liquidity for that time period, maybe you should look at some hedge funds or some other alts. Make sure you do your due diligence on the full market, depending on how much money you have, and where you need to be.
Sorry, Victoria, what is an interval fund?
So interval fund's a mutual fund, but it doesn't have daily NAV and redemptions. Typically, it's monthly or quarterly. So it's basically like a hedge fund light. So technically, it's a mutual fund. You can buy it if it's available on your platform. It's run like a mutual fund. You see it there. There's no extra paperwork. It's a 1099 versus a K1. But it does, like, redemption process is different. So it's a quarterly lockup typically, and so the way I put it is hedge fund light. So it's kind of this way, and I'm all about democratizing alternatives, but there's also a reason some alternatives are for ultra high net worth people is you need to understand what liquidity means. You need to be able to understand what these investments come with a different risk profile than a normal investment. So I always get a little worried whenever new products come out because they may not work as intended, or they may end up blowing up.
Yeah, I feel that way, especially about the democratizing access to venture capital, where it's like, oh, a few $100 invest in like an AI company that has 2 employees. It's
if you've heard about it on like Sirius XM radio, probably shouldn't just put your money into it. Or if you get like a internet advertisement for venture capital, like, or Facebook advertisement, I've got a couple of those, and I'm like, whoa, buddy, like. I'm happy they can do that, but I think it's also some of those things are very risky. You need to understand what you're getting into. And I'm not saying they're bad investments, but there's so much heightened due diligence you have to do on VC specifically, because you're saying, hey, this company is not fully formed, but we're gonna make it work and we're gonna make a ton of money.
Right.
But when it is that risky, you really need the right management team, the right access to capital, the right market, the right support and connections to make that company really work. I mean, there are companies that fail every day, not because they're bad products, but because they're poorly run companies or they didn't have the right access. And, that's just the way that this world works. You can have a wonderful company and still not make it.
Right, exactly. And also, even if the company you're investing in is the next Amazon, the platform you're doing the VC through, it has a lockup. And, at a time when credit cards are putting a $200 hold on your credit card to buy gas because the price of gas is so expensive, like, now may not be the time. If you don't have the ability. Victoria, I want to ask about recession. How are you thinking about the odds, not just of an economic slowdown? We know the rate of economic growth is slowing, but a true economic contraction, as well as the R word, the recession word, which it's thrown around. It's 2 consecutive periods of nominal GDP contraction, but really the word recession means whatever someone who's saying it means. Yeah. So if enough people think we're in a recession, are we in a recession? And then also, how does that impact your portfolio allocation of credit risk, duration, equity? Yeah.
So we are team recession, sadly. Sorry, not to be cheering that on, but we've been calling that for a while. And you're right, it's a technical definition. And they just, I think, today revised down Q1 GDP even further. So Q2 is looking a little sketchy. And that would be the technical definition. But I think, not to play the let's look around and how does the world feel, but I feel like we're in an emotional recession already. You look at consumer sentiment, you look at where PMIs are heading, you're looking at where, some of the charts of like business expansion and anything like that. You definitely feel a contraction right now. Hasn't hit the labor market, but we had so much slack in the labor market. It's going to take a little bit for that to catch up, as well as the concerns on housing rolling over. Housing definitely hit a bubble, and that may end up rolling a little bit more. So yes, I do think we're in a recession. At some point, I think we'll check that box. And again, by the time we hit a recession, a lot of the damage has been done because it's a lagging indicator. So that's more of like a crowning achievement, like congratulations, we're in a recession, but everything else, a lot of the damage, the market's a leading indicator. A recession is a lagging indicator. So, you look at this and that's my concern. And I know that the Fed is saying, yeah, we can land this, that we can soft land it. At this point, I'm just hoping to walk away from the crash landing. And because I don't really see a soft landing, because the Fed historically has not done well with time periods like this. And again, it's not all their fault. They can't control a lot of these things. But look, recessions tend to be shorter. Bear markets tend to be shorter than bull markets. If you look at an average, which we think this is going to be an average recession at best, then it's not going to be the end of the world. So yeah, it's going to hurt. People are going to lose their jobs. There's going to be stress and pressure, but it's going to be something we got to make sure that you don't over panic. So right now, when people think recession, they think 2008. And short of 1932, that one was like the worst one out there. So sometimes you got to make sure you step back and realize there can be other recessions that aren't quite as devastating as '08 was. So, that's why we're focused on quality. I think you're still short duration. Look, that front end of the curve is going to keep coming up. Come July, you'll be able to buy some really short, bonds making 2.5% basically. But 2.5% and 8 inflation sucks, but we definitely invest in a relative world, not an absolute world. So you have cash making 0. You have a savings account right now making maybe 1%, or you can buy a short T-bill or CD making 2.5%. And so I'll take my 2.5. I'll sit somewhere safely, and then I want my blue chip stocks. And again, we're trying to avoid landmines this year. We want to be areas we think are going to weather stress. But I think this is going to be short. Like I said, I kind of see this turning around in the fall because I think the Fed's going to hike aggressively. That's going to turn us over. And then once the Fed hikes, and things start to really fall apart, then they'll be like, oh, surprise, we're dovish. Haha, please stop hurting.
Yeah, so you think that once the PMIs go significantly below 50, that the Fed will pivot? You think
contraction? Yeah.
Yeah. Okay.
Yeah, and that's again, we're so used to things move so fast right now. So even monthly indicators feel slow, PMI and things like that. So I think they're going to contract. I think everybody's under some pressure. We'll hit below 50 for contraction. But I think just generally speaking, the amount of so if you're an average person, then you're already in a personal recession because of what this has done to your income. So your rent's probably gone up, your gas costs a lot more, your food costs a lot more, and then we all didn't get to travel, so now we're traveling, and your travel definitely costs a lot more, and God forbid you're buying a car. So even if the markets aren't there, technically, I think you could argue anybody making less than 100,000, even 100,000 people are feeling like they're in a recession because they're cutting back, or it hurts more and they're dipping into savings, or they're putting things on credit cards to maintain lifestyle. You're starting to see credit balances creep back up. Because people are trying to maintain lifestyle in an era of very, very high inflation. So I don't think this is 1980s or so. I don't think we'll get that high, but we also started much, much lower. So the 8.5, I think is going to moderate, but I could still see us at the end of the year around 5 or 6. We got to get oil prices down. You need the supply chain to not lock up. You need the labor market to be a little less tight. You got to have some things that just tend to take time to actually turn around.
Right. And so that 6% inflation by the end of the year, do you think that would be sufficient to motivate a Federal Reserve pivot or? Depends
on the labor market. So if the labor market started hurting badly, then maybe they've got to do something because right now they can ignore the labor market. So if the labor market starts rearing its ugly head, housing rolls over, liquidity rolls over, something like that, they're going to need an external catalyst. And I think the only things that would move them, in my opinion, is labor market coming under stress, unemployment rising, and continuing to rise, liquidity drying up in cash markets or in bond markets, or the housing market imploding a little bit. One of those three would definitely start to destabilize. So at that point, then they kind of have this thing they can say, well, yeah, inflation's high, but they don't have a but right now. Mm-hmm. The only thing they have is that inflation's high because everything else still works. So as long as everything else is still working, why wouldn't the Federal Reserve hike aggressively?
As someone who rents in a city, I'm very far away from the housing market. But I look at the chart, I see that mortgage rates have just absolutely exploded higher. How could you explain that? Is it just supply and demand? More people want mortgages, fewer banks want to do it. Is it the plumbing of the mortgage-backed security market? Because we're seeing some pretty 3 standard deviation moves in terms of moves from treasuries in terms of spread.
Yeah, so some of it. '08, we have to go all the way back. What is that, 14 years now? Yeah. Oh my God. '08 really is some of the root cause. So that was such a bad recession that hit specifically the housing market that we underbuilt for about 5 years, massively underbuilt housing for 5 years. So then we're playing catch up now. So we've been playing catch up, and it didn't really speed up until more recently. And at the same time we did that, COVID hit, which then set us back again. But then people started moving. And again, we used to have all of this great data of here are the known patterns. And yeah, we have ebbs and flows in city, out city, this or that. But people started moving in ways they hadn't moved before. And so then you've seen certain communities like your Austin, Texas, your Miami, Florida's of the world like just explode because people were no longer as tethered as they used to be to a different location. So I think those two factors really put the pause, and then low rates because everybody could get a mortgage. Banks wanted to lend money to people. It was easy credit and low rates. So the market worked. And now that the market, you're at a 5 mortgage, give or take, and supply is getting built. It's also, is the supply getting built in the right places? There's still some shortages because people migrated in ways we hadn't seen before. And I think that migration, kind of tethers in with the whole work from home. That migration is probably going to stick around a little bit because there's a lot more jobs that are acceptable to be done remotely and not, I'm technically an old millennial myself, so don't hate on me, but the millennial and the younger generation does tend to very much care about work-life balance. So the desire to live in a tiny New York City apartment, you see all those laughable pictures where it's like a studio and like the shower and the bathroom are in the kitchen. Like people's desires to live in apartments like that and work, 80 hours a week has changed, not to say there aren't people willing to do that. There always will be. But I think people started taking a step back and kind of driven by pandemic and saying, well, what do I want my life to look like? Where do I want to live? And quite frankly, some of that was things that people like, I didn't think about that necessarily. I just needed a job. Like that wasn't as big of a decision for me. I just wanted a job that paid me money,
Yeah. And so for your investing, how are you thinking about mortgages, mortgage-backed securities? Because, I saw a recent interview, Howard Marks, legendary investor with the Financial Times. He's getting very aggressive, his own words, in all the stuff he invests in, high yield, distressed, mortgages, CLOs. But I'm looking at, high yield spreads. I'm thinking, he can't be super excited about where high yield is at. Like there hasn't been that much of a sell-off. But the huge sell-off has been in mortgages, which, for Ginnie Mae's are essentially credit risk-free, essentially, so.
Those 14 years have given us short memories.
Well, the interest rate, but if there's interest rate risk, but there's no credit risk, right? Yeah. Interest rate risk is real for sure. So there's been like huge sell-off, like, Annaly or investment REITs that, the dividends are like 15%. Are those attractive to you or not really?
Yeah, I don't think, because of their supply constraints, I think the market's going to hit. I think you're just going to see, first off, I feel terrible for young people coming into the workforce right now because it's kind of miserable, and it's a little sad. There's kind of this feeling that I can't buy a house or I'm going to be stuck renting and I don't have a good job. There's a little feeling of malaise, I think, in the younger generation right now. So I don't think the housing market is going to crash. I'm not quite on that side. I think you just need to be careful what you're buying and understand what you're buying. That would be my best advice I could give, quite frankly, that, chase the risk you understand and you can feel comfortable with. If you don't understand it, don't buy it. So I don't care what it looks like on the screen or how well it's done. If you don't understand it, don't buy it. It's plain and simple. And that'll help you avoid a lot of things. But I think investors, there's a lot of great platforms now, but you got kind of thrown out in the big wide world of investing. And there's lots of siren lures from lots of ETFs. You want to go triple net short on the 30-year treasury, knock yourself out. But whoo boy, when that goes wrong on you, it goes wrong. And liquidity on those gets locked up too. So I just think investors, that would be kind of my parting thought is I think there's tons of opportunities at all times, right? You might need to be patient. Just because there's an opportunity, that doesn't mean you're going to make money tomorrow or the next month. Opportunity investing sometimes comes a year later, but you need to be patient. And then you need to understand what you own and how what you own will do during a time of stress. So if you can't see how it did in a 2008 or a 2018 or other times where it was very, very stressful, or you feel comfortable with the back test or the risk statistics and what it is, you probably need to avoid it a little bit. Be boring. That's my entire summary. Be boring.
Yeah, I think that's great advice. Yeah, know what you own. If you don't understand it, get the hell out and don't get into the triple longs, the triple short, or they have a five times left. Oh, never.
I'm sure. I'm sure.
Yeah, my final question I think it's only in Europe, thank God. But my final question is talking to investors such as yourself, listening to other financial media, reading reports. a lot of people have gotten very bared up. They weren't positioned for it over the past few months, but now they're bared up. They get the message. How come the S&P 500 is only down 22%? And might I ask, why is volatility itself so low, where we're not seeing sort of 4%, 5% down days? It's just sort of drip, drip, drip. And does your answer to that question inform? Obviously, I'm not asking you to call a bottom, but does that inform you of when it's like a good time to buy aggressively?
Yeah. So you want to look for signs, right? The VIX has been super quiet considering how many ugly down draws we've had. VIX over 40, RSI actually hitting oversold momentum. The market has been, especially up until June, the market was still like, oh, growth is crappy, value is holding up pretty well, energy still doing well. And finally, in June, you actually saw some capitulation of winners, which tends to actually happen as a bear market goes along. So there's kind of stages of a bear market. I tend to think we're maybe in the 6th, 7th inning. The worst has probably happened. June's super ugly. We'll see. We got a whole another day, so maybe we can go up like 11% tomorrow and make June a little bit better. But the velocity of this bear market has been pretty fast. So I think it's stylish now to be a bear, but the thing you have to realize is, you need to be prepared to update your position. So when you feel there are signals, either from Fed and economic signals and data points there, or from technical signals, does the S&P hold this 3815 level? If it breaks, where's it going to go? If you look at the Fibonacci retracements, that's not super awesome when that one breaks. And so I think you just have to be very, very well aware of, just hanging in there. So that's not fun. It's boring still. But if I think we're at least halfway through it, which I do, you're probably better off just holding what you own at this point, because when that bottom comes, those days right after it tend to be the best days of the rebound. So if you're sitting out, first off, I'm going to say you're not going to feel comfortable investing in the bottom because it's going to be scary. And then secondly, you're going to miss probably the first few days. And then there's this thing, and it happened to everybody. It happens to market timers all the time. 2009 and 2020 are the best examples, which both happened in March. But so you have your rebound days, and then you feel stupid because you missed the rebound days, and you say, well, I don't want to buy it now, right? It's expensive now. It'll come back down. This is just a bear market bounce. So now you sit out the first couple of days, and then that turns into a month. And suddenly you're sitting out 6 months to a year later. And now you're like, well, now crap, I got to get back in. So, that's honestly what happens to a lot of people, because when the market bottoms as a leading indicator, it bottoms while everything else sucks. So, and then when you miss it, then you feel like you've missed the opportunity, and you're going to wait for it to come back. You don't want to be dumb and buy when it's moved up 8% already. And with this market volatility, you can see this market move, 5 to 8% in a week right now, much less, so if you miss those, that's why staying invested, even in a bear market, which is terrible, feels like you're lighting money on fire, but you want to stay invested because I've seen it happen many, many times. So, and then you don't want to buy in, and then you don't want to buy in. And now we're sitting a year later and the markets have rallied 30% and you feel really stupid. And I'm telling you, you have to dollar cost average your way in now because we're a little late. So, if you make a mistake, the best thing I can say is, one, you throw up and get over it. Don't make a mistake a worse mistake, right? So if you make a mistake and you've sold out, fine, and you miss it, then just suck it back up and get back in. If you get hit, then you need to stay with it. And I think sometimes it's the compounding mistakes that really, really hurt an investor. I got this wrong, so now I'm going to reach for this. Or I missed this, so now I'm going to wait because and I'm going to wait, and I'm going to wait. And then that one mistake that costs you 5 or 8% suddenly becomes a 30% mistake.
Right. And that's the mistake in a bull market. In a bear market is you buy it at 70, it goes to 55, you buy more, it goes to 30, you buy more. You can get chopped up. Well, Victoria, thank you so much for joining us. Been a pleasure having you on Forward Guidance. Would love to have you back. Can you just tell people a little bit about, if you have any research, or are you on Twitter? So where can people find you?
I am old, so I'm not on Twitter, but I am on LinkedIn and Facebook. That definitely made me sound super old. If you reach out to our website, gsquaredprivatewealth.com, there's an address there. We do a weekly newsletter, as well as we do monthly and quarterly updates. So we would be happy to add you to the distribution list. Just reach out and we'll put you guys on that. And we send out some pretty good stuff sometimes. And every now and then I'm right.
Every now and then.
Blind squirrel situation.
Wonderful. Well, Victoria, thank you so much.
Absolutely, guys. Appreciate it. Take care.
There is something that you need to be doing right now, and that is reading the Blockworks Daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks Daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.